Moderating the panel is Carol Klimas here, the VP of Communications at Big Yam. One thing you figure out very quickly is what the VP of Communications does, and that is everything.
So as the VP of Comms, I'm usually, with an emphasis in crisis communications, I'm usually the person counseling my clients not to answer questions. So today, I'm going to do my best to sit on the other side of that table and ask these guys some tough ones. Feel free, if there's something that we're not getting to, you want to elaborate or add on, please, by all means, throw something out from the audience, and we'll try and see if we can stump this very handsome and smart panel today. Smeets, I might have to start with you. I'm going to pick on you because I know you really well. Okay. But first, yeah, everybody should have a microphone. I know we've heard from Ryan and Tom and Scott as well, but maybe David and Jon, just give us a 1-2 minute introduction about yourselves. Like, you know, what about Reg A gets you out of bed in the morning? Like, why is this some exciting stuff?
Do you want me to go first? 2 years ago, when we were talking earlier, 2 presenters ago about the why, you know, the Jobs Act, equity crowdfunding, that is my why. I love it. It's what I do every day. I work with entrepreneurs because at the end of the day, I love watching the American entrepreneurial spirit. And I like watching people with a hope, a dream, an idea, a little money in their pocket, and absolutely going for it. Because as a CPA, I'm not very risk tolerant. And so I admire people that are, and I love to work with them, and I love the ideas that are coming out of these Regulation A clients. So 2 years ago, I thought to myself, no one in this country knows more about these laws than I do right now, so I want to know about them, and I want to be a part of them. And the companies that I've been introduced to have inspired me to even become better at what I do and interact with people like Tom and the lawyers and the marketing agencies like Big Yam to learn the whole process, because I know that if I just know the audit and the financials, I'm doing my client a disservice. I really need to know the process so I can advise them how best to go about the process and when to start the audit, and when to start the legal work, and when to start their marketing, because there's really a vast absence of knowledge out there because these things are so new. So with all the attorneys that are going to tell you a lot of disclaimers, I am the rah guy for Regulation A. And you know, if you guys want to find any of us after this event, I mean, there is so much knowledge in this room with Scott. He's on so many of these, and I've done so many of these. And these guys have done so many of these. This is such a wealth of information in this room right now. I really advise you to pick our brains if you're looking into this.
Speaking of knowledge, Mr. Jon, would you give us a quick introduction as well?
Thanks, everybody. We have not done any of these deals yet, so I'm excited to do the first Reg A IPO, and I think one of the things that has stood in the way of the process has been addressed today by Tom earlier in his prezzo. You know, it really requires a certain level of revenue, if possible, profit and scale and reach. And I think that the market is looking for Reg A deals that have a little more muscle or oomph to them. So we need to play in a slightly bigger universe. However, what has always interested me in the capital markets is inefficiency. And the capital markets have been great, obviously, for enormous companies. If you're Facebook, you know, Google, Cisco, et cetera, it's been a lovely capital market for you for the past 10 years. If you're a small company in the U.S. doing $60 million in revenues and making some money, hiring people, not so much. So there's a lot of orphan small companies in our universe. There's probably 8,000 companies on the OTC markets that are orphans. That is an extraordinary number. And there's some great companies in there. And I think the mission, an important mission for Reg A, is to get companies public and trading and not have them orphaned. Because we don't need 8,001 or 8,002. Okay, we need companies that are vibrant, that can continue to grow and continue to access the capital market. So it's very inefficient right now. Reg A Plus is the first smart thing I've seen come out of the government since I've been in business. Okay, they finally got something done
Jon,
that I think.
Are you going to go political on us at the moment? I mean, should we go there?
Should have hit that. Yeah,
Do
I'm
it,
ready.
Man. Do it.
I got to be careful. Chris is in the audience. He's looking at me.
And we're filming. That's the PR person in me as
So-
well. 2 cameras. Yeah, go
Anyway,
for it.
to finish that statement, it is the first intelligent thing that's been done, and I am optimistic. It's early days. There's a lot to be done in events like this, and thank you to Big Yam and team, Ryan, and driving this thing, and Manatt for your wonderful sponsorship. You're the man. That will help the process. We need more of these events.
So along those lines, this is basically if you could assemble a dream team of advisors for Reg A, you're looking at it, right? So I'm going to ask each of you in turn, what do you wish your clients knew when they came to you? Because this is all relatively new. We're building the cars. We're driving it down the highway, going 90 miles an hour in some cases. What do you wish they knew before they came knocking for help and support? Scott, would you like to start?
Yeah, because actually it works towards this conference. When Ryan first came to me and talked about putting this conference together and asked my thoughts on it, and he sent over his ideas and the agenda, I said he was really trying to do it from a technical and a mechanical and regulatory perspective. And I've spoken at literally hundreds of conferences, and the thing people gravitate to, because it's the linchpin of everything, is marketing. And I said, you got to change the agenda. Need more marketing discussion and topic. And that's what I wish.
How much did Ryan pay you to put that shameless plug in there? Do we,
Exactly.
Checks forthcoming.
No,
Free
I'm so, I mean, as a professional in this industry, I'm so excited to see Big Yam coming in and doing this, because we need more people who are really competent marketing firms in here. And that's what I wish customers who come to us understood, is that they can't just pay a lawyer and a CPA, get the stuff done, get it filed, and then think a broker-dealer or a crowdfunding portal or someone else is going to sell it all for them, because they're not. You got to think of marketing, and you have to allocate the budget for it. And it drives me crazy that people don't do it, because I want to see them succeed. It sucks to have to refund 2,000 investors out of escrow, and we have to do that not infrequently.
Dave, oh, yeah, see, yeah. We need a little more crowd participation in this. Agree wholeheartedly. David, you and I chatted briefly about people having a better understanding of the audit process, especially our entrepreneurs. Is that something where they're like, this should take, a few hours, maybe a day at the most, right?
I think if you would poll all the Regulation A companies that have gone through this process, if you asked what was the one thing that would hold you up or held you up, they would probably tell you the audit. Right? Because as entrepreneurs, as CEOs, executives of a company, you've probably raised your money in your past. You've worked with your attorney to provide subscription agreements, convertible debts. You kind of understand the process of what it takes. You might understand the marketing because you've marketed your product or service before. But, there's this thing called the audit. I've never done that before because I've never been part of a public company or been required to. So I get calls constantly 2 weeks before somebody wants to file and said, I need an audit. Can we do this in a week? And anyone...
The answer to that is yes. How much money do you have?
That's
yes.
right. We have teams working around the clock. So, most people are, going through this process not ready to be audited. So their financials aren't even ready to go through the rigorous process that's required. And 2, they don't know the timeline. First-time audits easily can go 60 days, no problem, not longer, if not longer, sometimes shorter, but, it's going to take some time, and it's costly. And you have to realize you're going to be doing this every year for the next year until you have some kind of liquidation event, someone buys you out, something happens, right? But Regulation A is requiring you to do this every year. So people need to, talking to their attorneys, when they're going through the process, their broker-dealers, whoever it might be, who's their kind of first contact point, and say, okay, I want to start raising money at this point. What do I need to start doing now? And kind of backtracking to what needs to be done. And the audit is likely going to be at the very start of that whole process, and that's what people are missing the ball on so far.
No, Tom, you had talked about not everybody's an ideal fit for this process. So tell us your thoughts on what you wish these clients knew coming in.
Well, it's interesting because if you take a look at the literature, the SEC views these transactions as public offerings. There's Section 12 liability associated for disclosures which occur in an offering circular. And I think people get used to the fact that what they would rather be doing is some sort of down and dirty private placement with a subscription agreement and a few small risk factors and a very limited view, and slap it all together and get their clients to invest in it and be done. And that's just not the way this works. The commission will review this exactly like they review a registration statement. They will ask questions of the auditors that are identical to those that the GAO would ask in connection with an S1 filing. And they will hold the client's feet to the fire with respect to liability for misstatements and omissions. And also on top of that, all of the marketing material, every bit of that is also subject to the same degree of liability because it becomes part of the offering circular itself. So I think the involvement of the attorneys is downplayed. I think and again, I know reasonable minds can differ, think that this can be done fast and cheap and easy. I just don't view it that way. I think you need to do it properly. I think there's been a lot of people, as Scott said, that have tried this and been unsuccessful at it. There's also been people that have tried this and gotten their rear ends in a ringer from this as well. So I try to tell clients to be cautious. There's nothing wrong with being aggressive marketing. We're all for it as well. But they need to be cognizant that they're conducting a public offering, even if it's a private transaction at the end of the day, and that's important for them to know.
Good advice. John, I know you had mentioned at the start of this that you haven't necessarily taken a client through this, but even on the side of advising what makes a good investment from a Reg A standpoint, what do you wish clients knew when you were chatting with them about this process?
So Tom and I worked on a company that was a plant-based meats company, and they're a good example of, I think, what could work in a Reg A, kind of a 60 to 70 million in revenues, profitable, growing at around 40%, and with a big constituency that used their products, so some brand recognition, nice mix. And they were bought for a very hefty multiple, so it was a good outcome for them prior to doing the Reg A offering. So a successful transaction. But I think what's been mentioned by this panel is understanding of the audit process and how long that takes. Brutal. It's always brutal. It's going to be more brutal than you think, and it was for them. You got to go with, I think, the best folks possible. And I want to sort of amplify what Tom said is that, once you're public or reporting, publicly traded doesn't matter, but reporting, you're out there. All your stuff is out there, right? And you're open to liability. So the standard, I think, needs to be pretty high. You'll have access to capital markets, and for entrepreneurs, sometimes they seek capital, and that's what they want, and that's all they want. They just got to remember that disclosures and sometimes a fair amount of mishigas comes along with that.
Ryan, can you put together some information on Mishigosh and what you're doing as a marketing person to bring some clarity to everything that has to get communicated to what, with the clients may or may not be a sophisticated investor. So what are you counseling clients to do when they look at Reg A?
Absolutely. I think echoing a lot of Scott's sentiments, it's the marketing being a huge component of it. But there's two others that I think are also key, and that is the maturity of the companies and the advisors around them. I do a lot of business development here in the state of Arizona, and in the state of Arizona, we have a lot of companies that fit the mold that John just mentioned, where they're probably, let's say, as low as 20 million in revenue, as high as 100 million in revenue, and maybe this is their first, maybe it's their second or third company that they've been a part of. And for them to not have a pool of advisors or folks in this state is a big challenge, and that's something that we're trying to fill in the gap here within the state of Arizona. Look across this panel; these gentlemen are all here from out of state. So I would love to see more professionals in this state start to step up to the bat and evangelize and get involved in these deals, so that we could mature the companies within our state to look at other options. If they're considering growing and they need money and they need talent, They may not necessarily check off all the boxes for a typical bank, or they may have a healthy distrust for venture capital or private equity. So this is another option for them to endeavor, and they need to get aligned with other advisors and other service professionals to understand where everybody fits and how they can go about this in the right way for them.
So I'm going to take a stand for the little guy here because I'm with you. I think it's an interesting play for our unaccredited, non-accredited investors, right? But you look at some of this and you're like, wow, no, I don't want to raise, $100 from 100,000 people, right? So quick show of hands, favorite unaccredited investor versus non-accredited investor, or accredited investor versus non-accredited investor. Yes, accredited investor. Who's your favorite? Between the two of them. Are we gonna no? You guys don't want to take a position on this one?
It depends upon the company
Yeah.
and the kind of capital they're raising. If it is a institutionally focused company, a big REIT or something like that, then an accredited investor makes sense. They're going to be higher minimums. If it's a company like Elio Motors or Ron Motors or Arcimoto or XTI or MedX or Brewdog or most of the other Reg A's that's consumer driven, then they need brand evangelists, and there's nobody better than having one of your customers that's an owner in your business. So the non-accredited investors in a consumer-based.
So what are the challenges that come with communicating with the non-accredited investor? Do you feel like you have to change some of those channels, the frequency, the information that we're providing? John and Tom both mentioned we still have to treat this as, we're following all of the rules. But anything that you feel that you've seen that's been out of the norm or has worked really well?
Brewdog had one marketing stunt where they put flyers in dead cats that they had stuffed and dropped them from helicopters onto crowds.
That's pretty interesting. Yeah. So, no liability in there, Tom. Are you cringing? Like any liability dropping dead cats from the sky? Yeah, that's awesome. Okay. How'd that work?
They wound up with almost 9,000 investors in their deal at a minimum of $95 per investor, which we're like, please raise it, but they didn't want to. They just wanted people in. But in terms of the messaging and things, I'm not the expert in that. I just wish people were doing it better, which is why, internally, like what Big Yam is doing, or with a company specific being involved, marketing experts, the messaging is incredibly important, and Ryan's much better.
Well, I think back to some companies. Does anybody remember when Sam Adams went public? Okay, what did they do after they went public? How did they brand their six packs?
Oh, yeah. Excellent. Hey, there's a seat on the panel, please.
Yeah. so they branded them with stock certificates.
Come on up.
Right. Total impromptu. Yeah. This wasn't planned. Sorry. Yeah.
Let's chat.
Yeah, I'm Pat Tracy from Computershare, New York. So I worked the Sam Adams deal. It was modeled after a savings bank going public. So in the case of a mutual savings bank, they have to offer shares to their depositors and borrowers. Okay, and I remember meeting Jim Cook. It was a firm commitment underwriting. Alex Brown back in 1995 is when it happened. And I remember meeting Jim Cook, the CEO. I said, Jim, you don't have to do this. It's going to cost you like $3 or $4 million, And I was like in my young 30s at the time. He goes, Patrick, I'm not selling stock. I'm selling beer. He goes, go, really? That sounds interesting. Tell me, what do you mean? He goes, well, and what wound up happening, just to make the story shorter, they offered 30,000 positions where, you could subscribe. I think it was 33 shares. It was like a $450 commitment. And they were looking to get about 100,000 people to send in, and that's what they figured they'd get. And so Jim had said, well, so what I'm going to do is I'm going to get the 100,000 people that are going to send in money. And this is before the internet, right? So, I'll have their mailing address, and I can target them with certain products and, find out certain needs they have. And it was a big success. They wound up getting not 100,000, but 400,000 people that wound up subscribing for the shares. It took our company about 3.5 weeks to return the mail that we didn't even open, because everything had to be time-stamped. And it was a really, hugely successful opportunity. And, the stock's been doing very well in the aftermarket, and they were a reporting company, have been for it's like 15, 20 years now. Wow. So that's a big change. So.
Does that answer your question?
It makes my point for me. And who wouldn't thank you for being here. And thank you for sharing that story. Sincerely did not know you were here. And I brought that up because that is on the consumer side. Those people who bought that, who purchased that, I mean, they're fans for life. They're investors. They're bought in, right? You think of the analogy in sports, right? Yeah. Everybody understands sports. There's one public company in all of sports. Who is that? The Packers, right? So because of the Packers, we know kind of the challenges within the financing a professional sports team, but also because of the Packers, every time they want to go raise money, what do? They release more shares. Now they're souvenirs, right? But it's a marketing campaign for them, but they're able to capitalize on a base that is rabid, that is livid for them, and would do anything to support them. And that's something that you have the opportunity to do here with Reg A.
So in a financial landscape that's fairly conservative then, and Tom, I'm going to give this one to you. These are not my words, but one crowdfunding expert called security lawyers the most conservative creatures on the planet. Is that a compliment? I'll defer the question.
The challenge for a securities attorney in working with a client and a banker is to find the right mix of marketing and disclosure. I mean,
so that's kind of to my question then. Can we get creative? Can we do these type of things in a conservative environment?
I think you have to be. I mean, one of the things that we pride ourselves on in the firm is getting to know the clients really well and understanding their business and putting forth and working with the bankers on developing the right message to be delivered to the investing public, because disclosure is just half the battle. I mean, and the other half the battle is making this, dressing it up to be an appropriate marketing tool to allow the bankers and the company to be able to market their securities. And if you don't do that, then you're doing your client a disservice. It's easy to have a very conservative document. And if you look at, one of the criticisms I have of looking at some of the Reg A documents out there is I don't think they do enough marketing. I think they're very generic on their face. I don't think they put enough spin on the good things about the company. There are some of the more recent ones that I've seen that look and smell from a disclosure standpoint more like a standard prospectus. They have good pictures in it. They have nice disclosures with respect to their strategic vision and strategies. They look and smell like a traditional prospectus. I think that's what people want to see. And so we work with clients. We've worked with Jon on transactions and are working with him now and some clients in the room here to set forth that very message. And I don't think if you don't do that, you won't be successful in these transactions. Yeah, it's a good point. I mean, my view has always been, and it's funny, when you go on a roadshow presentation, and Jon would tell you, you're at a roadshow, they hand out prospectuses, but no one shows up at a roadshow to look at a prospectus. They look at there's a slideshow, right? It's a PPT, it's an investor deck, and everybody wants the deck. Hey, can I take the deck with me? And the SEC says, well, no, you can't take that with you. You can't take it around. You can look at it. It's right here. And then and everybody wants to see that. They don't care about this document. The only people that care about that are the plaintiff's lawyers. But they want to see the marketing meat. With this thing, you can strip down your offering circular and present your investors with the exact reason why they should invest. You can give it directly to them. You don't have to go through all this crap or all this fuzz. You can deliver it exactly to them in whatever medium you choose, and they can invest based upon exactly that. That is a dramatic difference from a marketing standpoint, which differentiates this in such a radical way from a traditional offering. It's a huge, huge difference, in my opinion.
I think that's the most important thing to talk about is that, when you want to become a public company, or if you even want to become a public company, there's really three routes that have traditionally used. It's the IPO, it's a reverse merger, which have some really bad connotations to them. And now here's this new thing. And I think what we heard earlier is about Coco Chanel, you got to do something differently. What you just said, Paul, you got to do something differently. Guess what? Millennials are going to take over the population as the majority pretty soon. I know I hate it too. But they do things on the internet, and things are going to change. And I truly believe in 10 years, it's really going to be an education process. It's about educating bankers, attorneys, CPAs to say, hey, this option is out there, because still such a small percent of the population even know it exists. My best friends don't even know what I do half the time, and they don't know how to invest. And I talk to them about this stuff all the time. And it's going to be a process, but I think that if you have to realize that this is the different thing that will replace traditional S1s on the very small scale. You'll always have Facebook and Twitter and all those great unicorns doing big IPOs, but on the smaller scale, the small IPOs, I believe this will replace the traditional S1 within the next 10 years. I think the other interesting thing, I would love to hear a banker's perspective on this, though, is that 40 years ago when companies went public, they did so at a much smaller scale. And when we talk about accredited investors, only 3% is the metric I always hear of the population are ever able to invest in these private companies where all the capital appreciation occurs. So by the time the common folk, the 97%, get access to a company in the public markets, they're just hoping to eke out 7 to 8% in their 401k to hopefully someday retire. So this law really unlocks the 97% to make a life-changing event, although, full disclosure, they'll likely lose their money more often than not. But they'll also have the chance to...
You were a cheerleader. What happened?
There's also
What
the
happened?
chance where someday they'll wake up like their grandma did and say, I have this stock of IBM. Is this a real company? And gosh, it'll be worth a lot of money.
That crystal ball.
Not a registered, yeah.
I am not.
No investment advice.
John, do you care to chime in from that front, from a banker standpoint?
Yeah, the heyday of the IPOs was great. I mean, there were 12 store restaurant chains, and you probably know a lot of those now. Outback Steak, Lone Star Steak, Cheesecake Factory was a 2-store chain that went public and went to I don't know what the market cap got to, $1 billion, $2 billion, $3 billion. Cheesecake's a big company, and they used to have one restaurant in Marina Del Rey. So that's a true success story. The problem was pointed out is that people couldn't participate in it. Institutions back then would actually invest in small companies. Institutions today do not invest in small companies, and therein lies the problem. Institutions want liquidity. The smaller institutional investors have effectively gotten wiped out in 2008, 2009, in the great whatever you want to call it, right? They all got crushed. And so the people that are left need to put, $25 million, $50 million, $100 million to work. That does not help the restaurant with 12 stores and growing at 50%, or that does not help Chris Loeffler's great company that's doing wonderful things in real estate. That does not help those companies. Okay, so the only mechanism for these IPOs today is what we're talking about, which are, and you asked about unaccredited and accredited investors.
Very poorly I did, but
That's
yeah.
okay.
Trying to get you to take a position
You're
on this.
sparky and those shoes are great. So.
Thank you, John.
So the and you got me off point here, but
Totally distracted. I'll get you back on point.
Yeah, right.
It's what does the opportunity look like for the unaccredited investor? Are we seeing the democratization of investing in America? And that is a political statement, right? This, if done well, this should fundamentally change the business landscape in America. We should, once again, bring back some wealth to middle-class America. You talk about having stocks. I remember my father has oh, yeah, I've got, shares of AT&T, and they sit on it, right? What is this going to do to fundamentally change our investing landscape?
To Tom's presentation earlier, the problem is you said have to do well, okay? These companies that are listing on the NYSE and the NASDAQ recently, I think, Tom, you said 10 of them have come out and listed, and they're all trading below market price. We cannot continue to take these companies public and have them immediately trade below issue, okay? Everyone gets pissed. It's just a bad start. Gentleman from J.C. Bradford knows better than most how that works. The deals have got to work, okay? Because every time one of those happens, I go, ugh, because what that says is, well, geez, the only thing you can go public is Snapchat or Facebook was a terrible offering, bad example, but You know what I mean? It's like, so they'll price these things at 20, they'll open at 80, and everybody's happy, and those are the deals that people aren't participating in. And now the deals that people can participate in, okay, that took general solicitation money, were priced at 20, and the first trade's 15. That's not good. Okay, so everybody seems to be, not paying attention to that in the marketplace, but these deals have got to be priced to work, and the entrepreneur has to be guided to say, hey, you know what? Let's not do this at 10 times sales. Maybe let's do it at 5 times sales, and let's let the investors make some money, and then you can come back and raise more dough. So anyway, that's concerning.
I think it's a couple of things you really have to lead in. Imagine if Oculus Rift, instead of being on Kickstarter, was on Start Engine or Republic or WeFunder or something like that. And then a year later, all of those investors were part of that $2 billion sale. The media would have had a field day with that, and it would bring so many people into this. So we need some really key events to happen in this market like that. And then second of all, backing that up, are the broker-dealers. They've been very slow to get into Reg A, and a lot of it's because of regulatory and compliance and other reasons, which are incredibly valid. But now, like B. Riley, hasn't done a deal yet, but almost did, and you're going to be doing some deals. Other people, Matrix, after a year and a half of messing around with technology, finally got their first deal done. Hambrick has been a leader in the space. Only a small handful of other broker-dealers have. So we need to see more of them coming in and taking a leadership role and convincing their customers, their institutions, their wealthy investors and their retail investors to support these things in the aftermarket so that we can have a healthy system that just generates this time and again.
Tom, I think to that point too, you had mentioned in your presentation we have a layer of accredited investor and unaccredited investor. Does this, depending upon how you want to come out with this, does this create, this is for them, this is for us type of mentality within those two investor groups within the same offering?
No, I don't think so. I mean, again, if you try to compare this to a traditional public offering, in a traditional public offering, there are no limitations between accredited and unaccredited investors. They're all the same. This is a public offering. Tier 2 deal is a public offering. There is no distinction between an accredited and unaccredited investor. There is a sort of a rough limitation on how much an unaccredited investor can put to work, because I guess they feel they have to make sure they don't blow all their money. So, but if it's going to go directly onto a national exchange, even that limitation flies out the window. So I don't think there's an us and them mentality. But I totally agree with what's being said here. Look, this is a really cool way for a company to go public. And what's really important too that John didn't mention is that when he talks about 08, you have to remember that Scott mentioned some of the bankers that are participating in this space. And that's great. There's a lot of, but there used to be a wealth of mid-market bankers that served the middle market. There were tons of them, and they all evaporated. They just got destroyed, or they got acquired. And there's this need for the middle market to be served for a mid-cap public offering that doesn't exist. And it's hard to go to a banker and say to him, and I mentioned this in the presentation, say, you're a mid-sized company, let's do a $50 million initial public offering for you. The bankers and the client is all enthusiastic from a valuation standpoint, and the banker wants the business. Well, unless everybody is being completely straight with each other, what could happen and does happen is you get to the market, and the market doesn't like what they see, and the banker doesn't get the right reception, and it's not his or her fault, it's the market's fault, or it's the client's fault. That's just the reality. And the deal falls apart and it's busted. And so what happens? Now your client is damaged goods because they were out there and they tried to do a deal and they're broken. So they can't, what are they going to do? Go back out again? And they go, oh yeah, you're that broken deal that didn't get done. Yeah, I know you. And then not only are they broken.
Going to trade on a secondary market.
No, not only are they broken, they owe their attorneys and accountants $1 million. And their people are pissed and they don't have execution and the deal never got done. With these deals, although I don't disagree with John that they should be trading better, those deals, none of the 8 of them that trade raised $50 million, but all 8 of them executed their transaction, and all 8 of them are trading. Now, could they have done it better? Yeah. I don't think there's any doubt of that. And if I would have, there's many things you could look back on this in Monday Morning Quarterback and say, you should have done it better. And here's how you could have done it better. And right now on deals that we're working on, we can suggest how you can make it better. But that being said, every one of those got done. So those companies got their money, they got listed, and the bankers executed the deal, and it got done. And if those were traditional offerings, none of them would have gotten done, in my opinion. So, in fact, Fatburger was a withdrawn public offering. It was a damaged transaction, and they went to Reg A because they had no choice, and then were able to get it done only because it was a Reg A deal. And so for all the damaged transactions, that's why I like it for clients. Clients are sometimes screwed. They get, and this is no slam on bankers because some of my best friends are bankers, but everybody tries their best to be a sales guy. Here's what will work for you. Here's what will happen. Here's why it's great. Here's blah, and everybody has a story to tell. That's great. But at the end of the day, the client's the one that gets screwed by this, right? It goes through this whole process and tries so hard, and then they end up with a bill, and there's bitterness, and the banker and the professionals move on and do the next deal. And this poor person is damaged as a result. I'm not.
I think that's why you're sitting up
Shut
here.
up. That's but in this type of transaction, the way these are done, that the chances of execution are so much higher. They're so much more likely to occur. If a banker like Merriman gets behind a deal like this, it's because he believes in the deal. The chances of execution for the banker that truly believes in it or priced correctly for a best efforts transaction up to $50 million, in my opinion, are 5-6 times greater than the execution risk that it would be that if you did a traditional offering. I don't even think it's close. And those deals can get done, and then the client benefits, and the banker, and everybody benefits. And so you have proper execute. That's why I like it, and that's why I think it's good for clients that we represent. Because it's for better or for worse, a lot of them have just been put into tough spots here.
David, I'm going to ask him a real quick question before we chime in on this. But
I got to add one
go
thing.
do it. Yep.
When the deals don't get done, who gets paid?
You people, lawyers.
No, that's not always true.
I just wanted to point that out.
Oh my God! No fighting on the panel. No fighting on the panel.
So when the bankers and the company have been humping the deal for 4 months and it doesn't get priced, and you're right, sometimes I'm teasing Tom, that the lawyers get left out in the cold too. I just want to make sure that both constituencies are served, that the company gets the funds and the people buying the stock make money, okay? Because ultimately this big population of people that are buying Fatburger or whatever, okay, they got to make money, or they will figure it out and they will stop coming back, okay? Every single one of these deals is trading below issue. That's not good, okay? Got to fix it. And I think, you know, and plug-in for a firm like ours, you need a bank that can put their capital to work to do these deals, pure and simple.
But how much time do we need to give this process before we can all confidently say, yeah, these are the markers that are going to create a good deal? Is it 2 years? Is it 4 years? How much time do we need to see whether or not we can pick the good ones and the bad ones? Anybody want to have some forward-looking statements on that?
I mean, I think that all these companies are trading down. Believe me, one of them is our clients. And but we're talking about a very limited population for a limited period of time. You know, even when a credit investor puts their money to work to a private investment, they're probably thinking 3, 5, 7 years down the line for a liquidity event. So we're still really early stages. I mean, the best companies that we could think about all traded down initially. And I'm not going to say any of these companies will trade up because there's a lot of inherent issues that might prevent that, but we're very early stage. And I think that we can have a lot of fixes in place that will prevent this stuff or hopefully help this stuff going forward.
But it's only been 6 months. I mean, it's not 2 years, it's 6 months. The very first one of these companies that listed, that was 6 or 7 months ago. It's not as if that there's been, you know, 400 listings on there, but John's right. The problem with this, in my opinion, I continue to say this, is when people, in my opinion, I know this, not everybody looks at it this way. When this first came out, there were a large number of professionals and bankers that thought this was some BS structure. This is just another trick. This is just another reverse merger. This is just some other bullshit transaction in order to get you listed. That's what they thought. And that's what a lot of big firms still think. It's what they think. And they're wrong. But that being said, John's not wrong. When you look at stock price performance, the naysayers like that go, see, I told you. What'd I tell you? I told you it was that. And so it's when you're trying to be a trailblazer, it's tough when the initial trail is blazed and then it turns out to be a rocky road. It's hard. And it's hard when you're trying to, people hear it all trying to help clients and do something. When that happens, it makes it much harder. And so I think it's predicate on, if we're going to do these deals, to do them the right way so that it leaves a legacy and ability for other people to do them that don't include people at this table. I mean,
Very well said. And I think, Scott, you had mentioned earlier, too, we need to celebrate the wins and the successes that companies are having as part of this process, even if it's just, hey, we finally got our audits in order, or we're having an opportunity to have conversations with our brand evangelists that we never thought to have before because we, didn't necessarily open that door. So how do you feel we need to celebrate these successes when we have 8 deals on the table and not quite as good as we'd like them to be?
We're not celebrating those companies, at least not yet. But as it attracts more investment bankers in who are going to give people better advice, and they're more mature companies, I think that we'll see more success stories coming up. But communicating the success, a lot of that, if you got your deal done, then as Ryan's presentation pointed out, there's also the aspect of after market, after IPO, communicating with your investors. You need to communicate with investors and the media in order
They're
to...
terrible, by the way. They're awful.
Exactly. But you need to communicate earnestly, regularly, positively, candidly, openly, honestly, but you need to get the word out there, and hopefully some things you're doing will catch on. It's somebody, there have been some giant brands that have talked about doing a Reg A. I haven't moved that way quite yet. Some have gotten close. That would be potentially tipping points for the industry. But I think there could be an Oculus Rift or something. Maybe a Shift Pixie, which isn't trading that well, gets bought out by Zenefits for $1 billion. And suddenly everybody makes a lot of money. Something like that will happen. There will be some trigger events, but just haven't happened yet.
Will you be writing a book about that? Because I understand.
Probably, yeah.
Probably, excellent. We're trying to get you a plug-in for that book. You don't even have an outline yet.
I was going to say that I think that even though this is the wild, wild west, I do think that young companies could really benefit from stealing some good ideas from larger cap companies. Take some of the best practices and things like corporate governance and compliance and investor relations. Take a look at some of the websites of some of the best companies and brands you trust out there, and take some of that and bring it into this world, in terms of communicating with investors, build up trust with investors, and with the, I'm not a banker, but I would say some of the companies, you have to also have patience. Some of these companies that are trading under, let's see what happens with 3 good quarters of good earnings where they start making some money, and put that with a slick investor relations program that goes out there and puts the market out there. Maybe you can turn it around.
A couple quick questions. I saw your hand a little bit earlier. We'll try and stay true to our schedule.
Sure, Paul Sim, Solar Pool Technologies. I'm just wondering, if the CEO walks through your door and says, I'm thinking of doing a Reg A, what's the profile of that company that gets you excited, that thinks, yeah, this could really be a success?
I'll talk about one company that recently came to me, and I thought they had a perfect profile. Without trying to be too specific, they were doing about $20 million in revenue, $3 million in profit. They had a consumer product that sells for over $1,000, so most of their customers are probably affluent people, and the technology is just cool as can be. I mean, there is nothing cooler than their product. And I thought to myself, that's the company that should be doing. They need growth capital. They need to really blow this out of the water, and they need to get their current customers involved even more to sell their products to their friends and family and everybody else. And to me, that was my kind of no-brainer profile client, but I'm sure there's plenty more.
Yeah, and the company that can take 20 to 30 million in capital and really put fuel in the tank and show that the earnings on the other side, come out of that. That can be a real estate company like Caliber. That can be a cool technology company. The consumer-facing side is a good element. But folks that have a constituency of people that believe in them and will buy their product, which will be this stock, is big. That's the most important thing, I think.
Okay.
Hi, Tyler Scott, Versant Capital Management. I have a question about, in terms of why is this compelling for the most talented entrepreneurs? Why would they not want to go to the biggest VCs? We have massive dry powder, unicorn valuations, it's just one firm you have to deal with. What is appealing to the best entrepreneurs about this structure?
Let me hit that with a certain person in the audience. With Elio Motors, which was a startup, losing money, what was your market cap at the raise?
To answer your question even more specifically, and what I would urge everyone to definitely do is to stay for the panel at 3 o'clock, because as I sit here and I hear all the information that has been so articulately shared, there is so much to comprehend about this offering that until you hear what it looks like when it goes through the entire process, you can't even comprehend all the decisions and all of the strategies that you must put forth before you even make that decision.
As an entrepreneur, I raised $100 million in venture capital for one of my companies, one of the very first internet service providers. I had 11 VC on my board. I can tell you for a fact, it sucked. With FundAmerica and Prime Trust, I have a single family office that's backing me with millions of dollars, much better experience. But if I look at the Reg A, as an entrepreneur, it's very attractive to me because the valuations are often higher than you'll get with a venture capital organization. You wind up getting some liquidity, and you have paths to trade with freely tradable securities, and I can go after non-accredited investors. So these are all very attractive as an entrepreneur.
Two more questions? Yeah.
Well, we got a bunch more, but
Hi, my name is Matthew Wolfson, and I'm with Electromedical Technologies. And about 10 days ago, we just were qualified by the SEC for the Regulation A+. So we're a new hatchling, and we have a solution to the opioid epidemic using electronic delivery of frequencies. My question is, our broker-dealer is saying that after we complete this round, it's better for us to trade on the NASDAQ versus the OTCQX? Is there a benefit or is there a difference, or why would one be better than the other? Yeah. We just don't know. We're like I said, we're a hatchling. We're unfamiliar with this, and we've been in business over 10 years with 10,000 customers.
A suggestion: I would lose the hatchling.
Yeah, okay.
You're a rocking company. You've been around for 10 years. You're gonna hatchling sounds like.
Okay.
So the OTC has its benefits, NASDAQ, but when you're listed, all of the broker dealers, the Schwab, the Ameritrades, et cetera, can accept your securities, okay? And the gentleman from Computershare can speak to this, but there are logistics involved with share ownership and who will accept them. And there's still a lot of broker dealers like Schwab in some cases, or TD Ameritrade, big brokers that will not take your shares. And so your people are going to be bummed when they spend their money on this stock and their broker at Schwab won't allow them to deposit it, not much less trade it. Okay, that's a big issue. So you want to, speak to that, but you want to dig into that.
There's the wit and wisdom of whether or not you make your securities DTC eligible. So it's too long to get into right now, but making them eligible to enter with the street name system so that brokers can hold it in their own name. So if you have shares now in a publicly traded stock and you put it into your Schwab TD Waterhouse account, that so that they can trade it in their system. It's something which would be worth having a discussion with your broker or any of the might be on the panel here. I think that might be of help to you.
Another big point is state blue sky. So if you look at the difference between exchanges, OTC versus NASDAQ, OTC is less expensive. You can do it with lower market caps, and it's a little less friction. NASDAQ is a little more expensive. But on the other hand, if you're going to go OTC, you have to file under Rule 211 with FINRA. You don't have to do that if you're going up to NASDAQ. If you are going with OTC, you can opt into the merchants list, which is, 37 states, 34 states, something like that. So you can then sell your securities. Your securities can be bought by people in 37 states. What about the rest of the country? It's not included. You have to go make application to those states individually, and then you have to file annual reports with them individually. So OTC can be quite a burden. There's a cost savings associated with it, but if you file with NASDAQ, you're automatically exempt from having to register in all the states.
Yeah, I think we're right behind Elio. I think we're the second here in Arizona. So.
Awesome.
And I was going to add one thing because I was actually talking with Matthew. Hey, how's it going? One of the most important things is when companies are going through this process is talking about the long-term goals of companies and do you want to be on the OTC? Do you want to be on the NASDAQ? Because we're finding now that clients are coming to us because they found their auditors aren't what's called PCAOB registered, meaning they can't work with public companies. And so therefore they have to go get re-audited by another firm at their own cost, at their own burden in terms of human capital to go through this process again. So when I talk to companies, I said, if you do ever even think of wanting to go public into the OTC, into the NASDAQ, NYSE, then you need to use a PCAOB firm right off the bat. It doesn't cost you any more for the most part. It's almost exactly the same in terms of the audit process. It's just that special designation we have that we get put through an extra round of due diligence to make sure we can work with companies that sell securities to the public.
Okay, we got one more. I saw.
You want to go on? Was it a woman? Or, do you have a question? Oh, well, then you're better looking. There you go.
Thanks. Hi, my name's Travis. I'm full disclosure. I work with Chris at Caliber. I used to work with Jon. But my question is, there's been a lot of talk about the execution of these offerings and the aftermarket support, what makes them successful, right, on a price standpoint. What I want to understand, I know from a traditional S1 offering and what typical investment banks do in the secondary markets and create a market and write research, how does that look in the Reg A environment? What kind of things, so this is maybe to you, Jon, and maybe to you, Scott, what kind of things are you guys seeing in aftermarket support with Reg A Plus offering companies versus what we see in the traditional S1 filing process?
Trav, I think that's the issue. There hasn't been. So I think it's a wonderful thing, like Tom was saying, that these clients can get capital. I think this is structurally something that's relatively easy to fix. The big deal is that the government came through with something that works and is helping companies raise capital structurally. There needs to be research. There need to be broker-dealers with capital making markets, supporting the offerings, after the deal. That's not going on right now. And that's that's structural. That's easy. The hard stuff's been done. So all the things you know about, writing the research, making a market, having people talking about the stock and being out in front, and also reaching out to the marketing. We're talking about marketing a lot. Being effective with the marketing post the deal is huge. You can't just do the deal and stop the marketing.
So go ahead. Parting words, please. Go right ahead.
Exactly what Jon just said. And add to that many of these companies are very young. Their employee count is not that high necessarily. So they don't have the money or the sophistication to understand how to get out there, especially the CEO and the CFO, how to get out there and court research and develop market-making relationships because they're spending their time building their freaking business. They don't have time to go do that because, again, they're young companies. With more broker-dealers, more firms writing research, of course, if you're making a market, you don't now automatically write research on it. The regulators killed that. So it becomes even harder to get people to pay attention to your company and help market it that way.
Just one quick thing. You might benefit from retaining an investor relations firm or hiring a professional investor relations officer who knows the lay of the land, the public company world, to really help a young company out.
Gentlemen, I want to thank all of you for your time, for your wittiness, for your very forthright answers. Can we give them all a quick round of applause?